story that we have over on City AM is Lloyds Q1 results and regulatory bonus. So Lloyds Banking Group Q1 results have been analysed to death over the course of the last week. So Lloyds have mirrored the disappointing top-line performance already seen by Barclays and RBS, adjusted their revenues 4% below the market at 4.4 billion, while unchanged pre-tax profits of 1.6 billion also came in slightly below what they actually hoped for. They're blaming all sorts of stuff, all the good buzzwords, Brexit and all sorts of things. Is this just to be expected? Is this the banking industry?
Incumbent's top line is slowly eroding year after year after year. I don't think this is particularly surprising, but the inverse is the question is, where's growth coming from? If you look at all of their investor decks, they've all got this shiny innovation story on the first page, and then you look at the numbers and where the revenue's coming, it's not coming from having an app. It's not coming from you did some digital. It's not even coming from you spent 2 billion on digital transformation. So where is growth coming from? So people are still looking at these as yield stocks, not growth stocks. So I think the shareholders are looking for that yield, and they are continuing to deliver on that. But for as long as the goal is managing cost, it feels like that's another way of saying managing decline. Like, where is growth going to come from?
So I'd argue, though, if you look at Lloyds are, so they've invested, 15 million in buying 10% of Thought Machine?
Yeah.
So actually their story here theoretically could be dramatically changing their cost income ratio. And actually if they can take 50, 60% out of their back office costs because they can start, removing a load of that sort of tech debt that they've got in the back office, then potentially this is them setting themselves up for doing more in the subsequent years. Now that might not be impacting their share price now because that all sounds like gobbledygook if you're like sitting on a board and it really means nothing. But knowing what the Thought Machine guys are sort of cooking up, then that actually might be a really interesting way of them, addressing this problem and going about it in a different way.
Well, I think that the point on cost income ratio is really interesting because in the article they sort of said, the bank was praised for, bringing down its cost income ratio to 44.7%, which is very high, but compared to the incumbents is pretty low. So just for comparison, Barclays is about 70%. HSBC has been sort of between 57 and 62% for the last few years. And RBS is targeting, a cost income ratio of 50% by 2020. You compare that to a challenger bank or a new player like OakNorth. Last year or 2017, our cost income ratio was 58%, down to 37% in 2018, and it's now less than 30%. So dramatic differences, which obviously not having a bricks and mortar led model means we can make those cost savings much more easily.
And also your cost doesn't scale linearly with the growth of the business. The cost is you get a J curve because of the way the tech's structured.
A slightly different take, and I kind of feel the bullishness around the erosion, but in terms of actually,
you said bullish, didn't you?
Bullish, yeah.
I thought you said bullshit. That was
bullshit. I mean,
mate. I was like, I thought that was harsh. Like, I'm sitting right here.
David, a Freudian slip. I'm very sorry. No, so one thing that actually looking through the article, so they talked about in terms of the PRA, the systemic risk buffer requirements, and the changes to that. So on a positive for them, and I'm thinking more in terms of shareholder value, just in terms of that side of things, because they've taken a beating over the years. There's some breathing space that's now coming through in terms of the capital requirements. And if you actually look at the numbers, it could free up to £1 billion, in excess capital. So whether that actually goes back to them or somewhere else, I'm not entirely sure.
Well, and if you compare them to their peers, as I think was mentioned, they've been the least worst. But
low bar.
well, yeah, but I think David's point's an interesting one because when they announced the Thought Machine piece, they also announced that a buck of nearly 500,000 customers they were looking to potentially transition over there. I think time's going to tell of how do you actually go down that journey, because committing to it's nice, but getting customers on there is going to be really, really key. But do you think, David, we're going to see more of that trend then? Because that cost income ratio, as Val pointed out, if your challengers are coming in with a completely different cost income ratio, it's not being the least worst of the big banks that's the goal anymore. Now there are other people in town that can compete in a completely different way.
I think that's it. I think the ball has moved, and now being the least worst is not the number one. To your point, Val, actually the operational efficiency that we're seeing from challengers coming into the space is just absolutely resetting what the chart kind of looks like. And definitely, Rebecca, we can talk about this for another hour in terms of core banking, given your heritage as well. But the big banks are in so much debt when it comes to these things that fundamentally just restructuring how those things are being done and investing in technology for today rather than yesteryear just changes how it's not just the cost, it's actually the opportunity cost that they lose by something taking 9 months that takes an OakNorth 9 minutes.
Exactly. Absolutely. And also from a tech provider perspective, it's the same thing. You see disruption in the banking industry, but you also see disruption in the tech provider industry because of legacy technology and the older companies that have acquired, and they can't cobble all the stuff together for banking versus kind of a thought machine or a new product, Mambu, et cetera, that's out on the market.
I think what's so exciting about that thought machine partnership is, I suppose Lloyds have got the scale that in some sense you can make the argument they've got the ability to be a very fast follower. So with this kind of thought machine partnership, you can make the argument, there's loads of cost income benefits there, but you're also kind of preparing yourself to be flexible in the future. Looking at loans, for example, right? No one, as far as I know, or I wouldn't, want to apply for a credit card through Alexa. But in 5 years, that might be what everyone wants to do, right? So these sorts of tie-ups sort of all push themselves into that funnel of being flexible for the future, and they can pivot and move in line with what the market actually needs.
I was going to say, just one other thing that I was actually looking at, which is going to start taking effect over the next couple of months at least. I hate to bring it up, but the PPI side of things. And again, it's a different take, but there's been so much focus in terms of this, I say the big banks, in terms of fixing everything over from the last decade, 2 decades. We're actually from the 29th of August, hopefully we should all stop getting those calls. But what it does mean is actually, I think they recently said they had to set aside another 100 million for that. I think on a positive, it means that they can turn a corner and actually start focusing on the future. And I think that's a really important thing as well.
The days of having to just constantly write down every quarter's results because of the fines from the financial crisis and PPI and everything that came with it could be coming to an end, and that's a positive.
I don't know. I like for PPI, sure. But
there's got to be some other skeletons in there.
I mean, it's like what part of the movie is coming next? It's if it's packaged accounts, if it's wealth investment stuff. I honestly don't think the lessons from that have been learned, because it's not really about just doing wrong. It's about your back office processes in terms of record keeping just being fucking terrible.
I mean, there's a reason why the Terminator was used for those TV adverts. Now I think about it, I will be back. There is something lurking around the corner.
The bigger short.
Yeah, in the industry that I work in now, in asset finance and automotive finance, the FCA has just written a new article about affordability and about duty of care, and there's a huge amount of money that's going into being ready for 2020 and some more compliance that's coming around. So I think there's a lot more yet to come around
and
write-offs.
And there's a whole ecosystem built around PPI. Those guys are going to go root out the next problem. Anyway,
The Martin Lewis ecosystem.
Indeed, yeah. Speaking of people who are back.